Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh with us. It must be Friday. Jim Welsh from Macro Tides is joining me and you to talk about what's happening in the markets today. And what an interesting reaction today, don't you think?
Yeah, it is. Again, I think markets are coming to realize that despite good inflation news, the Fed isn't going to really change policy course in the direction. Right. So I think, to me, that's what's coming through, because markets have been rallying, anticipating and pricing in the idea that the Fed's going to cut rates in the second half of this year. Yeah, there may be one more rate hike in May, but the Fed funds futures are saying they're going to cut in July. And I think that's completely out to lunch. And for faithful viewers of our weekly meeting, I'm happy to send the April macro tides to them. All they have to do is send me an email, jimwelshmacro@gmail, and I'll, what you'll see is an explanation of why the Fed is going to continue. I think they are going to raise to 5.1. I don't think they go beyond that, Blake. The Fed has been telling everybody what they're going to do for months and months. We're going to raise to a modestly restrictive level. At the December and March meeting, they pegged it at 5.1. One more rate increase gets the funds rate to 5.25. The median is 5.125 to be exact. And then they're going to stop and they're going to wait.
And the other issue, I want you to chime in here, is that we are kicking off earnings season. We are, what's the S&P trading at for
18
via
18
earnings or 18? Yeah. I mean, and we know we're at some pretty lofty levels. And does that justify knowing that hey, we got companies reporting right now? The Fed's probably going to continue to stay tight. You got the economy is actually slipping. Yeah, and you see retail sales completely reversing and slumping this month, and inflation expectations still high. That's kind of a recipe for disaster. So, I mean, bad data doesn't necessarily translate to good for the stock market at this point, right?
No, I mean, basically, this is the message we've been delivering for weeks and weeks and months, that we were going to come to a point in time where the economy would show more signs of slowing, and you ain't seen nothing yet in terms of the slowing. Okay. But the Fed isn't going to cave in right away in ease. Powell and company have said repeatedly, we're not going to make the mistakes of the 1970s. And there are two sides of that. One is, we're not going to keep raising rates until we crater the economy, because that's going to force us then to cut rates. And they've also said it would be a bigger mistake to cut rates too soon than wait. So to me, it's obvious, and has been really for some time. The Fed's going to 5.1. I think they do, in fact, hit the pause button for a period of time. But the notion that they're going to be cutting rates in the second half of this year can only be justified as if the economy is not just slowing down, but it is weakening significantly. And historically, the stock market doesn't do well, as you point out, PE ratio at about 18. And earnings, what's interesting, the quarterly earnings expectations, Blake, are still $50 and change for the first quarter, and by the fourth quarter, it's going to be 58 and change. It's like, these people are out of their minds. They're nuts, I just don't see that happening. And so you have the market priced for this recovery in the second half of the year in terms of earnings, at a time when, and we've, this is kind of ad nauseum, leading economic indicators, the yield curve inversion, the tightening of lending standards we started talking about months ago. It's only going to get worse on that front. So when you add all this stuff together, the economy is going to slow meaningfully. And my take has always been, as we got near mid-year, that might be about the tipping point, and then slowing more in the second half. So that's to me, the valley there, where you have the street thinking earnings are going to be better in the second half of this year. And to me, most of the data points and indicators are suggesting, no, just the opposite is going to happen. And so that creates this window where we see the economy slowing, Wall Street starting to cut earnings, and the Fed holding pat. They're not caving right away.
Well, let's talk about that in a little bit greater detail, because the first chart you bring up is about rate cuts, and you say it's not likely. So talk about this.
Yeah, well, this is Fed funds futures. And, prior to the regional bank issue, they were pricing the Fed going to 5.66, even though the Fed has said 5.1. And then, oh my gosh, we get the regional banking crisis. Oh, now the Fed's going to switch. They may raise in May, but they're going to be cutting rates, so that by the end of this year, they're pricing in the Fed funds rate 2 to 3 rate hike or cuts. Pardon me. It's just not going to happen. The blue line shows what the Fed has projected, holding steady through the course of this year. And I think that's the Fed's intent, and only something fairly dramatic will take them off that, course. So again, you have, Wall Street keeps thinking that, inflation is coming down, the Fed will be able to cut rates. That'll bolster their case. And again, we've been talking about this for months. Since November 30th, Powell's speech at Brookings, he said, inflation is important. We think it's going to be coming down. The key thing is the labor market. And with labor market tightness, we need to see that that's easing, because wages and wage growth are the things that sustain inflation over a period of time. Yeah. And the Fed has projected the unemployment rate rising to 4.6%. Well, historically, anytime the funds rate is, or the unemployment rate's gone up by more than 0.5%, like 3.5 to 4, you're in a recession. And for the first time, the minutes show that the staff, not that these guys are wizards, the staff were the people that was telling Powell and others that the inflation was going to be transitory in 2021. And that's where Powell got that information, and he relied on it. So I'm not going to, say, now finally the staff is waking up. But the fact that they publicly kind of said, our base case now is a recession later this year. So, again, I think everything's adding up for this reality check for Wall Street, that the Fed isn't going to be cutting rates at the first sign of softening. This is exactly what they want to see, is softening. And that means earnings got to come down.
Yeah.
And all right. Well, some other reasons why the Fed, and we're going to talk about those, I think, really quickly.
Yeah. Well, let's start with the Dallas Trim Mean PCE. Yeah. Why'd you bring us this chart?
Okay, because the CPI is coming down, and I wrote about this since last October. The CPI is going to drop a lot going into June of this year. I mean, I think the CPI is going to be down around 3%. But if you look at other measures of inflation, and what the Dallas Fed does is take all the categories within the CPI and the personal consumption expenditures, the PCE, which is the Fed's more relied upon metric, and they get rid of the categories, about 25% of the categories that have gone up the most, and they get rid of the bottom 25 that have gone down the most. So what they're looking for is that middle ground. What's happening in the middle? Because ultimately, that's what's going to be more determinant of future inflation. What we can see down at the bottom line is the trim mean. That's, taking away the top and the bottom. It was 4.7% in September. In February, it was 4.6. It's down a whopping 0.1%. And I wrote about this really numerous times. We were going to see headline inflation come down much faster than core. And in the CPI this last week, I said, we're going to see the core rate tick up, which it did, from 5.5 to 5.6. So again, these are the things that are forcing the Fed to say, we need to see a lot more information about inflation coming down, and with the prospects that once down, it's going to stay down. And so this is the kind of stuff that makes the Fed say, we're going to 5.1, and then we're going to pause and wait to see what happens. And, again, I think Wall Street just ignoring some of this other information.
Yeah. And the ignoring could be, look, I got money to put to work. I got to make it work. Right. So, but at some point, when nothing's working, that's when you start having a, get me to cash kind of issue. Right. So,
right. And, what I pointed out the last few weeks is, if you look at the rally, it's really been focused on a small number of stocks that have big weightings in the S&P and the NASDAQ 100. But if you look at the advanced decline line for the NASDAQ composite market, it's just barely above the lows of October. So you've seen this incredible boost from a small number of stocks, while most stocks really haven't participated. And the advanced decline line on the New York NYSE is also comfortably below where it was in early February. So since early February, we've seen market breadth deteriorate pretty meaningfully. And historically, Blake, what happens is you need some trigger to get people to say, okay, we're going to sell these stocks that have been really doing quite well, but they're going to need justification to say, yeah, we're going to sell those and buy these other ones. Well, with the prospect of the economy slowing and the Fed not coming to the aid of the market, it's hard to see that transition taking place. So the point being is, once we see those mega cap stocks start to weaken again, the odds are the rest of the market isn't going to all of a sudden get about a strength.
All right. Well,
be soft.
Yeah, that makes sense. All right, the next chart you brought up is the unemployment rate. What do you read out of this, and why is it important?
Yeah, Powell has said that the labor market is the kind of the key to monetary policy going forward.
Yep.
So anyone who thinks the Fed is going to start cutting rates in July, I mean, the unemployment rate in March was 3.5%. It's near a 50-year low. Hello. The Fed is not going to be cutting rates with the unemployment rate under 4%. So anybody who thinks that,
and even if it's above 4%, I mean, it's 4%, Jim.
It's still 4%, as you can see from this chart.
Yeah.
You can see where 5% is, because it's like what, 2.5, 5, 7.5.
Yeah.
So again, the Fed has said labor market tightness is the key, and I think again what they're looking at is we're going to hold the funds rate at a high level for a long time, so that the economy, and their hope is, doesn't really weaken significantly, just slows and grows by a very, very modest amount, so that slowly but surely the unemployment rate goes up a little bit, inflation comes down over a period of time. That's their hope. I think the odds favor us going into a recession, but that's their game plan, and that's why they're going to stick to it.
So, the next chart you bring up is lending standards, and this is a big deal because we have obviously we got earnings reports from JP Morgan, Wells Fargo today. A lot of the big banks, but they're not a lot of the banks that do a lot of the lending in your local community. Is that correct?
No. The small banks that's banks with under 250 billion in assets, provide about 38% of overall lending. 67% of commercial real estate. They're also significant in terms of mortgage lending, auto loans around 15%. So small banks are a big deal. But again, when I saw that lending standards went up in the third quarter and then in the fourth quarter, I made a big deal out of it, because effectively what we have is the Fed raising the price of money. And now small banks are not only raising the price of money. Yeah, we'll give you that loan, but you're going to pay an extra 100 basis points for it. Or we're not going to give you the money because we're tightening lending standards. And so what this chart shows, it goes back to like 1966. So it's a nice chart. And what we can see is every time lending standards went up meaningfully, as they have in the last 6 months, and we'll get new data the first week of May for what happened in the first quarter. There's no doubt that they've gone up. So the point being is every time lending standards have gone up, it starts to choke off liquidity flowing into the economy. All of a sudden, businesses can't get money or they pay up for it. And every time that's happened, we had a recession. So this is why
the recession is the red highlighted areas that you see.
Yes.
Here. Okay.
Yes. Okay. And there were times where the Fed raised rates, but we didn't go into a recession. And Powell, a year ago cited, there's a way to pass to a soft landing and no recession. Yeah, that's because banks didn't increase lending standards. So, the instances where rates went up, but the banks didn't tighten credit significantly, allowed the economy to slow, but not going into recession. We're not in that case. So this is why I've been making a big deal of it now, just because of the regional bank crisis. More people are tuned into, they're going to start raising lending standards. No, they raised them in the third quarter, fourth quarter, and in the fourth quarter, 43% of all the banks had increased lending standards. Historically, whenever it's over 20%, you've had a recession. So this, what's happened with the regional banks is only going to intensify that, and it's going to hurt small and medium-sized businesses who rely more heavily on banks. They can't go to the credit market and issue a bunch of bonds. So again, to me, this is why I feel and have felt pretty strongly that the economy is going to slow pretty meaningfully as we progress towards the end of this year.
Yeah, that's again a scary thought, but you definitely have me a little concerned. I know you wanted to show
Yeah.
the dollar, but I think first you wanted to show gold. So let's see how the markets are reacting to what you're talking about. So here's gold.
Yeah, gold again. Gold has rallied more than I expected. Get that out front. At the same time, the dollar was a little bit weaker than I thought, and it was weaker because of the good inflation news, and then people jumping to the conclusion that, oh, good inflation, the Fed will be cutting rates. Wrong. And I think that dollar weakness coupled with that idea that, oh my God, the Fed's going to be cutting rates and therefore inflation is not coming down. Gee, let's buy gold. But from the price pattern, to me, it looks like I was looking for a pop above 2007, which we got. Then we got a dip. We got another pop. There's still a chance you could get a dip and one more pop. But again, looking from the lows of last September, we're getting awfully close to what I think is the end of a 5-wave rally, which longer term is bullish. To me, it seems like, okay, that's wave one of the next big advancing wave in gold. So what that implies is, yeah, after we get a pullback, you're going higher.
Yeah.
Now it's a question of how much of a pullback. And I think 1920, that was an area of resistance, and for a number of times over the last year and a half or so. The 382 is probably around 1850 to 1875-ish, and then wave four of lesser degree is the 1807 low or whatever that was back there. So my point is, I think gold is setting up. Sentiment is starting to get pretty crazy. I did a call with a group of advisors yesterday, and I said, yeah, I'm getting calls from clients who usually aren't very smart about markets, and they want to get in gold, and they want a bigger allocation than they normally would ever take. So sentiment has responded to obviously the move up, which is classic. So to me, everything is set up technically for gold to pull back based on the chart analysis and sentiment. And you can see at the bottom panel, the RSI. So back in
very divergent
4 weeks ago, yeah, it was 75 or 76, and the high yesterday was 67. And I have found, Blake, RSI divergences are meaningful. But let's say you get an RSI reading of 82 and then 76. Well, that's not as strong of a signal because 76 is a really high number.
It's still strong strength.
Exactly. The better signals come when you get a divergence where, like we have right now, 75 to 67. Yeah. Under 70 on that secondary high. So again, technically all this is set up for a pullback in gold. And then it's just a question of, okay, how deep is it going to be?
Right. Okay. Well, the next chart you brought up was the dollar. Let me pull that up for you real quick. Here's the dollar.
Okay. So my supposition here is that people are expecting the Fed and markets is going to be cutting rates in just a handful of months. I think that is completely wrong, based on what the Fed has said and everything else, where inflation is at. And so I just think these people are out to lunch who think this. That opens the door potentially that we had the rally up from 101.05, I think it was 100.80 back the intraday low. But that's where I recommended buying it, selling gold or the dollar at 105.20. I think this has been a wave B, and it took out that low maybe by a few pennies. But what that implies is we're going to see a C wave up that gets above the 105.88, which was the high that we saw, back in late or early March, I guess it is. So if I'm right, that the market's come to realize, well, wait a second, these guys aren't going to be cutting rates. They're going to hold it at a high level. I think that then becomes supportive for the dollar. So that's my take. And obviously, chart-wise, it dovetails obviously with I think the message from the gold chart as well.
Okay. Well, we did dip a little bit lower, but hey, you're still looking for higher prices from here. Yes. The next chart is TLT. So it looks like your view hasn't changed here.
Not too much. Now, the one thing, and this is an older chart, so I think I probably sent you a bad chart here because it doesn't have the action of the last handful of days.
Oh, okay.
So my bad if I did that. My thought here is that low at, where I say buy at 103.75, the price low on that was 103.60. Then it rallied up, made a lower high at 108.87. I think that low at 103.60 was wave A. This rebound here is a B. It's going to go down towards the 103.60, maybe take it out by a small amount. That'll complete an ABC. And then I think the from a bigger picture standpoint, yeah, this is definitely an old one. 103, getting above that 110 up towards 115, 117. So again, my take here is the idea that the Fed is going to raise and then hold. Some people say, wait a second, that doesn't jive with bond market rallying. In a sense, it does, because what does it do to the probability of a meaningful slowdown / recession in the economy? It's going to increase it. The Fed not responding immediately to economic weakness. I think the bond market responds favorably. In the short run, I think we're getting this pullback because if people are like, no, I guess the Fed is going to continue they're going to hike in May. So I just think you have another pullback here before the bigger move takes us up towards 115, 117.
I see. And then the last chart you brought, which is an updated chart, which would be the S&P.
Yep.
How do you feel about the S&P here? Because we just pierced that resistance today, and it looks like we're slipping now. So what do you think?
Yeah. Well, as I noted, I think when we talked last week, the 50% retracement from the January 2022 high at 48.18 and the low last October was 41.55. So what I basically said in this past week's weekly technical review is take a 25% short position above 41.50. And if it gets above 42.10, increase it to 50%. There's still a chance, Blake, that we'll see the S&P make a move and get above 41.95. But I think the clock is running out here because we're getting closer to that time where we're going to get more data showing that the economy's slowing. Earnings, I think on balance will be okay, but more companies probably will start to warn a little bit about, hey, the balance of this year type of thing. So again, my bigger picture view has been we're getting this rally. When it's over, we're going to see the S&P drop. And well, at a minimum, we'll see 3,800 again. I think that gets taken out, and ultimately the S&P goes down to the October low just below 3,500. So that's why we're finally to that point where I think they've run the string about as far as they can in terms of the economy, earnings expectations, still expecting it to go up, is going to confront and collide with the reality that the economy is going to show more and more signs of slowing. And the Fed isn't coming to the rescue. Wall Street's been conditioned for 20 years, and we talked about this quite a bit. Inflation was down around 2% for most of the last 20 years. So whenever anything started to weaken significantly in the economy, hey, the Fed would respond quickly. With inflation at 4.5%, 5%, the Fed can't respond quickly. They've told us that. And I think Wall Street just hasn't gotten that email yet.
Well, speaking of emails, and before I, come back to you, Jim, I wanted to show, this is an example of what your macro tides looks like. So people have an idea, and this is one that was sent last week, so everybody can kind of take a look at what how in depth you go in detailed with the chart you're looking at, the analysis you go through. I want people to kind of get an understanding of what it is that when they email you at Jim Welsh Macro at gmail.com, that's an example of what that macro tides looks like. So, Jim, I want to
here. Yeah.
Go
just
ahead.
Quickly. What I'm trying to do is combine what's going on with the economy, what the Fed is going to do in reaction, and what they're telling us, and then technically, what are the markets? How do they look? And there are very few people, I think, that combine all three of those facets as effectively. I've been doing this a long time, and I've learned a lot. And as an Irishman, I've learned a lot from mistakes. So,
you know, and us that just us that trade the markets, I take my personal experience as a trader. I love to talk to people like you. I talk to a lot of very, very smart macro minds. And for me, I'm just trying to form a thesis to trade around, and I use my technical analysis to find those better entry points. And you really help polish those skills for a lot of traders out there. So Jim,
thank you.
Yeah, I want to say thank you for joining us every week. If you guys and gals like what you hear here on the Trader Summit, make sure you give Jim a big thumbs up. Subscribe to the channel, share with people that you trade around and your family and friends. And I'm sure Jim would really appreciate that as well. So Jim, have a great weekend. We'll talk to you. We won't talk to you next week as I will be out of town. But maybe we can somehow try to fit it in sometime next week, but we'll see about that. Okay.
Yep. You got it, buddy. Have a great weekend.
You do the same. All right. Bye-bye. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.